Thank you for joining us today, Andrew.
Thank you.
Well, the JSE managing to close slightly firmer on the day. Lack of conviction, it seems, in the market to go any one way right now. I suppose perhaps the ECB and the BOE policy meetings tomorrow would be a reason to stay on the sidelines.
Yeah, I'm not so sure. I think we saw a strong start to this morning. Commodities were up. There's speculation around monetary easing in the US, the EU tomorrow. China as well. So yeah, started strongly, and then as we saw, commodities came off during the day. Yeah, still neither here nor there. It's a lot of speculation out in the market. Valuations, the market looks fairly valued. So yeah, there's no real driving theme at the moment coming through.
For you though, in terms of getting exposure to various sectors right now, which we're asking everyone this, and we know that the resources sector is cheap, we know the industrial sector is expensive, but based on everything that's taking place, especially with regards to stimulus, possible more stimulus moving into the market, which sector is poised for upside?
I wish I had the answer for that. I can speak from a valuation perspective. Obviously, we're a deep value manager. Looking through the cycle, the resources, as you mentioned, they've just continued this drive to deeper value. The outlook's obviously muted. Global growth, sentiment around global growth isn't great at the moment, and the commodity prices are dampened based on that. So your resource companies in particular are offering the deepest value, but then again, you've got to look at the outlook for them. Industrials, on the other hand, specifically your multinational, or what I would call your multinational industrial companies, your large cap industrials, like your MTNs, your SABs, your Richmonds, that derive earnings from abroad, they look exceptionally expensive at the moment. Naspers is a good case in point. Massmart, we saw with a trading update today, your retailers, all of them are looking quite expensive. So that's an area of the markets that we're avoiding at the moment. On the other, or on the flip side of that.
Let's start with Massmart, because you mentioned Massmart, obviously, that trading update, making what 61.2 billion rand in sales for the year. That was up by 15.5%. We don't have a breakdown of those numbers right now, but from a top line perspective, is that type of growth good enough for a company like Massmart? Are you encouraged by those numbers?
Yeah, those are great numbers. They keep on doing it for the past few years. We've seen not just Massmart, your retailers in particular, your food retailers, your ShopRites, etc. They've all done exceptionally well. These numbers just keep getting better and better.
So what does that mean around getting exposure to the stock, as you say, at an expensive price?
We haven't had exposure to retailers for quite some time now. They're priced for perfection, if I can call it that. And at the moment, they're getting it right. Massmart trades on a P of about 35 times. Now, on the markets on a P of 12 times, you get a sense of the valuation differences between what the market's offering and what you're getting, or what you're paying up for to get exposure to these retailers. So at the moment, we stand away from the retail space. They're getting it right, which is supporting these lofty multiples. When we start seeing these retail numbers come off, I think you'll see a big decline in the share prices.
You of course mentioned the resource space. I suppose, where are you buying right now specifically? Is it the diversified? Is it the ones that have been the hardest hit? The likes of Amplats, of course, comes to mind after that trading update.
Yeah, we're not increasing our exposure to resources. We are overweight resources, so we're not buying per se. But where do we have exposure? Mainly to the diversified resources. Anglo American is our biggest exposure. Sasol is another one, and African Rainbow Minerals. So more your diversified resources. Having said that, we do have exposure to gold through Pan African Resources, which is a smaller junior gold miner, and our exposure to platinum comes through Anglo American, which is Anglo Plats, obviously.
When you talk about Pan-African, that does seem to be a favorite if we're talking about gold miners. And just looking on the day, obviously Anglo Gold Ashanti managing to eke out again on the day, one of the biggest gold miners, and there has been so much negative sentiment around all the cost side pressures that they face. How well does Pan-African manage those issues that they have to face?
I think they do it exceptionally well. There are a couple of things that are for certain in the gold industry. The rand gold price is not always going to work in your favor, and you're facing very high inflation costs. In order to nullify these threats, Pan African Resources focus on high quality ore bodies, and they do that through Barberton. They're getting 8 grams per ton, which is right up on the highest end of the quality curve. And then looking at the cost, they're right at the other other end of the cost curve. Their costs are below $800 an ounce, which is exceptionally good when you're looking at South African miners. So they focus on their high quality ore bodies, and that's the way they try and mitigate these risks, which are now going to come. The gold price is not always going to work in your favor. And as we know, we're facing costs, I think, of about 14-15%. Labour costs, electricity costs. So, yeah, there are definite risks there, but we are satisfied they're doing enough to try and nullify them.
Satisfied enough to hold the stock, of course.
That's it.
Let's talk about Hideko, because there's been announcements of M&A activity there, looking to or has bought paid 41.5 million rand for Deltec. It's a company in the battery operated space, 25 million rand for a company called Proof. But yet the stock traded down on the day today, but a stock that has rallied hard. What are your views on what these acquisitions mean?
Yeah, Hideko is a share that we like. We've held it for a very long time. These acquisitions, the two that they announced today, they're very small in the broader schemes of things, but we generally like companies that don't make acquisitions, that return cash to shareholders. Companies.
How can you say that? Because obviously acquisitions help to grow
companies
often.
Companies in general are pretty poor allocators of cash, so we'd rather like to see that cash being given back to shareholders as opposed to used on acquisitions. Very often you hear the word synergy being thrown around, and very often synergies aren't there when we're told that they are. What Hideko are very good at is they make acquisitions at very good prices, and they make acquisitions in line with their operations that they currently partake in. What concerns us is when companies pay up for acquisitions, and when they make acquisitions in areas that are outside their area of expertise.
So, but you're comfortable with these acquisitions?
So these acquisitions are definitely in line with what they do. They're imports of industrial goods for mines, heavy industry, that sort of thing. So these acquisitions are in line with what they do. I can't really comment on the price. I haven't had enough detail to see whether they paid up for it. Looking at the history, Hideko are generally a very good acquirer. I wouldn't expect them to have paid up for them. But they again, as I say, they're very small acquisitions.
Yeah, we'll delve into that at another stage, but of course a very small stock on the exchange. For the meantime, the Aussie managed to close up by just over 0.1% on the day. Andrew Dittberner, Senior Investment Manager at Cannon Asset Managers.